Good morning, Aaron. Hello, everybody. I think that the insurance industry is poised to, and in some cases already is, playing a burgeoning role as we try to work out how to, in particular, adapt to climate change. We've spent, for those of you who are at the Business Summit, and then again today, a lot of the focus is going to be on the financial instruments and tools that will speed up mitigation efforts. And I think it's very important to understand this conversation in the context of Paris, which is that if we are not able, as a financial community, to bolster support to the most vulnerable in particular, but to everybody, to be able to be resilient in a world which is volatile and a world in which it is more uncertain, then we will have failed. And we will have been seen to have failed by negotiators, and that deal will be more difficult to achieve. The role of the insurance industry, therefore, is really becoming a bigger and bigger and bigger question. Now, the good thing is I think that the insurance industry is responding. And at our annual meetings, the fund and the bank's annual meetings, we had the first Insurance Development Forum, really bringing all of the partners together, industry-led forum, sort of looking at all of the issues. But why is insurance so important? First of all, you guys know how to price risk better than most people. Most people talk about the need to do it. You guys do it. And so learning from the insurance industry what the best practice is and how to use that pricing of risk across planning and across the development of new instruments and tools will be very important. Secondly, there is extraordinary upswing in demand from developing countries, from cities, from provinces, from communities for help with mechanisms to support their resilience, including financial protection. And so the deepening of insurance markets, the liquidity in insurance markets, the regulation of insurance markets for this world where the demands and the roles that insurance could play are much broader is very, very important. And we see much more dialogue now about the prominence and the importance of really developing insurance markets, whereas perhaps the last 20 years everybody was just sort of focused on credit, maybe even savings, but now really a focus on insurance. And of course, Leapfrog and others can talk about some of the amazing developments in that way. And then I think that the real and present danger is extreme weather events. And so the particular role that the industry can play, working together with the public sector to help government understand the need for mechanisms that will allow them to build back and bounce back better immediately after extreme weather events, and which will allow them to invest in the resilience so that those events don't knock them completely off course is very important. So we've got a lot of experience working with the insurance industry on catastrophe risk, catastrophe bonds, other policy measures that allow governments and local authorities and communities to be able to access immediately funds. ARC has got an extraordinary early track record in Africa as well. So you're starting to see innovation in order to help at that level as well. But we're beginning to see markets now, and this is my last point, where the trajectory of extreme weather events and the trajectory of the impact of climate in the next decade or so is one which makes that market, it pushes that market beyond potentially insurable risk, right? I mean, we're talking about a country like the Philippines, which may have to sustain, 3 or 4 Category 5 tropical cyclones in a given year. And if one of those were to hit Metro Manila, which is 25% of GDP, we're talking about extreme impacts. And so we're starting to think now about wholesale approaches to resilience in which the private insurance market will be an extremely important component part, but on its own won't even be enough. The final point I want to make is that we talk a lot about insured risk. For the vast majority of developing countries, most of the risk is uninsured. 70% of the risk is uninsured. And so deepening and broadening, insurance is an absolutely fundamental first line of defense, as it were, for communities, for states, provinces, and for governments, as well as for individuals. And this needs to be a revolution. I think, therefore, the industry is going to need more products, more services, more partnerships in order to be able to meet that demand.
Rachel, thank you very much. And it sounds as though you're thinking of the sector not only in its traditional role of providing products and services, but also as a knowledge partner for governments and communities. Yeah? Okay, great. Peter Ellsworth, over to you. Ceres works with a number of insurers, analyzes what the sector is doing. Give us your perspective on where the sector is and how you've seen it change.
Thank you, Aaron, and good morning, everyone. For us at Ceres, the insurance sector is of strategic importance to our climate and clean energy agenda. We see insurers playing a significant role in how companies and investors think and act about climate change and climate-associated risks. One of the many things we're focusing on is how insurers may be able to help investors with a vocabulary around climate-related risks, and perhaps even help them put a better price on that risk. You know, when insurers underwrite policies on property, on business interruption, on errors and omissions, and on liability for directors and officers, they increasingly need to better understand and factor in climate-associated risks and how those risks are going to impact their pricing. Two examples will demonstrate what I mean. First, let's look at property contracts. As part of their core business practice, insurers have building data they use to understand and quantify risk in order to price policies. In the United States, some insurers are supplementing their own data by collaborating with our National Oceanic and Atmospheric Administration to identify high-impact areas of extreme weather, sea level rise, storm surge, and other climate change-related phenomenon. And in addition, the information from the catastrophe models used throughout the insurance industry to model loss impacts of extreme weather events, such as Atlantic hurricanes, is useful not only for underwriting and pricing purposes, but also to understand investment risks, for example, of municipal bond holdings in hurricane-prone areas. That data will not only help the core underwriting business price risk, but would also be invaluable to an insurer's own investment arm when assessing whether to invest in real estate in such locations, or in the bonds, equities, or other projects of companies having material exposures there. You know, and as such data and analysis enters the public domain, it would help many other investors understand and also measure climate-associated risk they may not currently be aware of or appreciate the gravity of. My second example addresses liability policies that protect directors and executives from shareholder lawsuits, which include fiduciary negligence. For example, the board or senior management of a company dependent on access to plentiful and affordable water may fail to anticipate the consequences of water becoming scarce and more expensive. Or an energy company may doggedly, some might say recklessly, invest capital to assess new reserves with untenable break-evens. To conclude, insurers need to understand these and many other climate-associated risks as well, if not better, than the policyholders they insure. As insurers get better at this and refine the tools that help them price these risks, that knowledge could lead to better decision-making around investments as well as underwriting, and help diversify and reduce the entire insurance company's exposure to climate. Aaron?
Great. Thank you very much, Peter. And already we've heard that the sector has something that the world very much needs and is being applied not only in terms of what direct clients can take advantage of and benefit from, but also much broader understanding of how we manage through this era. So now let's turn to two representatives of two of the most active, global, large, respected insurance companies in the world. I'm raising the bar on both of you with that. Philippe Derieux, why don't you tell us a little bit about how AXA is thinking about climate risk and adapting and evolving as a company?
Thank you, Aaron. I could not agree more with what Rachel and Peter have said, drawing a global landscape about the climate and how we are involved in. The first point is very easy to understand that as insurer, our duty is to serve our customers, and those customers are all very sensitive to climate. So that belongs to the heart of our business. Having said that, the big trend today is to improve, as Peter mentioned it, to improve our capacity to assess the risk, better model, and in more granularity, and also develop things that we are not yet developed, and that means some perils which are not even known or not yet well known in all territories, and not only in mature countries. So there's a big challenge, and thanks to the technology, the actual technologies, the big data, we can make a real step in better assessing the risk. What for? Not only for our own purpose, but also to help the society to the extent that we can make and do actions in more awareness things, or to do actions for prevention. That's one point. And the other point is to use also those technologies to develop, for example, parametric insurance, so index-based insurance, in territories where the local capacity to gather data or the infrastructure is not yet there to do some traditional insurance. And so we can speed up the protection of the whole world by doing that type of things. So that's very important to use the technologies and to develop for our own sake, but also to bring to the society advice, try to mitigate the risk, and then also protect. And as Rachel mentioned also, we do protect a part of the risk, not all, and so expand as soon as we have the capacity to really assess those risks, so help.
Philippe, thank you. As these new models develop, is AXA developing new business models to put some of these new products into the marketplace?
We are, progressing. It's not an easy journey because it takes, and so we need to keep humble on what we do, because that's, developing a model about a certain peril takes time, and you need to take, all the use to all the capacities and to the data and gather the relevant information to be sure that we are not stupid in what we do, and then, then advise on stupid things too. So if I take an example, we are about to finalize a specific model on the French flood. You would tell me, well, France, that's a mature country. I can tell you, considering the climate change and what happens, we need to restate things. And so we will be about to model fully, the French flood by the end of this year. But it has taken 3 years to us to develop that. And guess what, for an emerging or developing country?
Well, as someone who lives in California suffering through terrible drought, I know that these events happen, and California is able to withstand it better than less developed markets, but the impact remains very large. This is both intensely local and truly global. Andreas, tell us a bit about how Swiss Re, and I recall the chatting with the CEO of Swiss Re when the UN Global Compact was launched in 2000. One of the few CEOs at the time, I would say, who really knew that climate change was a business issue. So this is something that Swiss Re's been thinking about for some time, but how are you evolving the business as climate change has become a today issue and not a tomorrow issue?
Yeah. Actually, climate change has been a today issue for me for about 20 years. I happened to be at the first conference of the party of the climate convention, being one of the few business people talking about climate risk. All the others, the colleagues from business, were basically carbon people. They wanted to mitigate the effects of the negotiations to them. But why we were there is because we realized that climate change increases uncertainty in our business. That's one of the big challenges. As an insurer, you're looking at statistics, you're looking at the past to predict the future. But if this past or the present, the future isn't stable, the past isn't representative for the future anymore, you are having a big problem. And this is what we realized, and I think it's a continuing challenge. If we want to measure risk, quantify risk in a world where the climate is changing and the models, the climate change models aren't yet very precise about what exactly climate change means in terms of catastrophe risks, it's very difficult for us. I think that's one of the biggest challenges we have. There's a second challenge, which I would call the protection gap, and Rachel already mentioned it. You, I think, said it's about a third or two-thirds of the risks which are not insured, about a third only is covered. And I'm talking about big natural catastrophes, and you can take a catastrophe like the earthquake in Nepal, where almost nothing is covered by insurance, but you could also take a hypothetical flood in the Netherlands, and the Netherlands are very much prone to floods, and almost nothing would be covered there if a flood happened. So this protection gap is not something that only is observed in the developing parts of the country, but it's a global phenomenon. And this protection gap is increasing, for one part because of climate change, obviously, but also because of the economic development. We did a study, looked at various regions around the world, and we observed that by 2030, so about 15 years from now, in many places, total climate risk is going to increase by between 70 to more than 100%. And about half of this increase in most places comes from climate change, but the other half comes from economic development. And in a way, that's good news, because economic development is made by us, as is climate change, but economic development is something which we can influence more easily. So where we build, how we build, has a big influence on climate risk. In fact, almost all of that increase in climate change or increase in cat risk can be mitigated by building well, by taking the risk into account. And I think that's what we should do as individuals, as businesses, but also as governments.
Do you speak with governments today about trying to mitigate that risk based on the knowledge that you have?
Actually, closing the protection gap is very difficult, and we talk to governments because they are one potential actor that could buy insurance and mitigate the risk by doing that. But another challenge is also bringing insurance to people who never heard about it, maybe. If you talk about people in Africa, building a segue maybe to the next person who never heard about insurance, don't understand the concepts. So how can we get them to buy insurance? I think that's very difficult, a huge challenge for us as an industry.
Well, Andreas, you're putting me out of a job with that segue, but I appreciate it. Fatima, why don't you pick up exactly where Andreas left off?
Sure. My name is Fatima Kasser. I'm the Chief of Staff of the African Risk Capacity. The ARC was formed as a specialized agency of the African Union. We have 25 member countries to offer sovereign-level risk insurance to African governments, specifically to fill this need and demand for more and more the public sector is looking for contingency financing options to close this protection gap. And but similarly, we are cultivating demand at the same time as we're selling a product. And for that reason, we are structured as a two-tiered institution. We have the African Risk Capacity Agency, which is the treaty-based organization. It has its own conference of the parties and a board chaired by Dr. Ngozi Okonjo-Iweala. And we have a financial affiliate capitalized at $200 million that became operational last year, ARC Limited, ARC Insurance Company Limited, that is chaired by Dr. Lars Tinnel, the former head of the IFC, and actually on which one of our directors is Hans Peter, who used to be the CEO of AXA Re. And at the time when he was CEO in 2006, actually insured the first drought insurance transaction in an emerging market in Ethiopia that our same group put together. So we've been working on this a while. I think it's critical to get back to the point that Rachel made is, at what point does insurance become an option that isn't necessarily the most sustainable choice for a country? And what we've seen in our data from 1930 to, let's say, to currently, we had a dry spell, for example, in Niger, that a drying trend that began in the 1960s, moving into the 80s, really peaking in the 83-84 drought. And if you look at the 73-74 drought in the Sahel, the 83-84 drought in the Sahel and the Horn, they were some of the worst human tragedies in our recent history. So in order to, and what we've seen also is the 1 in 10-year event, that was the standard 1 in 10-year event between 1930 and 1960, becomes the 1 in 5-year or even more frequent event after that. And it's only now that, that the rains have really increased significantly to counter that, but that's 30 or 40 years later. So what the ARC is doing is designing what we call the Extreme Climate Facility, or XCF, which would be an extreme climate index that is structured similar to a catastrophe bond, where donors would pay the coupon. We have a good track record of using public finance from donor countries in an effective way to attract private capital. And those countries that are already managing their risk and paying premiums to ARC Limited would be able to access payouts from the XCF every 5 years for climate adaptation programs, or to finance their climate adaptation, such that we're hopefully using the insurance not just to manage the current weather risk, but then creating a layer on top of that to be able to build the resilience levels in line with the development and the population growth. So I think I'll stop there, and then we can pick up.
Just one quick question follow-up. So you mentioned Niger, one of the least developed countries in the world. For Niger to access, who pays? It's part of this overall facility, yeah?
Yep. So Mauritania, Senegal, Niger, and Kenya were insured last year in the 2014 season. We had a significant drought, one of the worst in the last 20 years in the Sahel. Niger, Mauritania, and Senegal all received payouts of about $25 million altogether to effect pre-approved, peer-reviewed contingency plans for responding to vulnerable communities. So, in fact, I think that what we believed was political rhetoric at the beginning, which around Pan-African solidarity and self-reliance, really translated into premium payments. So Niger, one of the poorest countries in the world, paid $3 million for $30 million of coverage from the ARC Limited, and it is budgeted to do so this month again. We have double the size of the pool. Burkina Faso, the Gambia, Mali, and Malawi will join this year. And we expect to have 16 to 20 countries next year. By 2020, we should cover about $500 million of agricultural risk in Africa with drought, flood, and tropical cyclone. And that is essentially not just interesting in terms of opening up the African market for reinsurance and aggregating that risk effectively, but also the annual general members meeting is African governments coming together to decide how they are going to manage their disaster risk for that year, and therefore changing the business model of how disaster assistance has worked for the past 60-odd years.
Great, thank you, Fatima. Jim, why don't you pick up and tell us a bit about how Leapfrog is also approaching insurance in emerging economies?
Happy to do that. And maybe I'll just give a sort of 1-minute overview of what Leapfrog is. So we are a social investment fund. We invest in businesses in Africa and Asia that focus on providing insurance and related financial services to what we call the emerging consumer. And the emerging consumer is the group that has left poverty and is beginning to enter, or sort of has a toehold in the middle class. And as people get this toehold in the middle class, so they start buying things like houses and cars and fridges, and with these things come financial services. So you buy a house and you need a mortgage, and with a mortgage you need insurance, and with a car you need insurance, etc. And so we back businesses that are essentially backing and focusing on the emerging consumer in Africa and Asia. And what I wanted to talk about really was our experience with the emerging consumer, and to present, I guess, a somewhat more optimistic story in the story of climate change has been largely quite a pessimistic one, and it's been particularly pessimistic around the emerging consumer. So there are these kind of, scare stories. Well, if in Africa and Asia, China and India, emerging consumers were to consume at the same levels as America, climate change would, dramatically accelerate. And I guess part of what we're seeing in the field is a more optimistic story that's beginning to emerge. And it's beginning to emerge in two different ways that I'd like to share with you. The first is in terms of what we're seeing to prevent further climate change. So what we're seeing a lot of on the finance side as opposed to the insurance side is quite a lot of microfinance institutions and other financial services institutions supporting the promotion of green technology, of solar panels, of solar lights. In Bangladesh, for example, $2.7 billion of finance has gone towards purchasing, low-income people purchasing clean tech. And so what we potentially seeing, and it's very early days, but it's an optimistic story, is people potentially leapfrogging the grid, right? So, just as in Africa and Asia, people leapfrogged the landline grid and went straight to cell phones because cell phones became redundant, we may or may not be seeing early signs of something happening potentially with clean tech. I think then sort of moving and sharing our experience on the mitigation side, one of the big challenges that you have with climate change is, of course, the associated natural disasters. And when a natural disaster strikes, when it happens in a developed country, it's dealt with insurance, and that's a very effective way of dealing with natural disasters. What tends to happen in developing countries, and particularly poorer developing countries, is there's a natural disaster, and then after the natural disaster, there's a request for aid, there's a lag, and then the aid comes. And that's a very poor and destructive way of dealing with natural weather-related catastrophes, because in that lag, quite a lot of the real damage occurs. But with an insurance mechanism, the payout is very much faster, right? And so you have far less of the negative consequences post a natural disaster. And so one of the things that we're doing at Leapfrog is working with businesses that focus on the emerging consumer and that are providing the kinds of insurance tools in a whole range of different products, health products, property and casualty products, that will help people cope when natural disasters strike. And just to give you some sense, Leapfrog has been going now for 8 years, and in this period of time, we've backed portfolio companies that have sold insurance products to 40 million people in Africa and Asia. 33 million of those people are low-income consumers, and what we found in a lot of the tests that we've done is that the vast majority of those have never had insurance before. So that's, for me, the second optimistic picture, that there's this groundswell of insurance companies that are reaching out and selling products to low-income people that can help mitigate some of the worst effects of climate change.
Jim, that's great. Thanks. And before I start tossing some questions to the entire panel, one follow-up for you. The 40 million you mentioned, what are their needs? How do their needs differ from people in other parts of the world, maybe in central Paris?
So there's a few. I think the key difference is really that the central difference is that they have less money. They are poorer people. And so the kinds of insurance policies that they can buy tend to have a much lower premium and less benefits. And that has all kinds of consequences, particularly for distribution, right? So you have much cheaper products, and in order for that to be done profitably, you have to have high volumes and low distribution costs. And so what we're seeing in a lot of our portfolio companies that we invest in are very, very innovative ways of distributing those insurance products, including through use of mobile phones, which we're finding is becoming more and more extensive, as well as through partnerships, for example, with microfinance institutions that are already reaching large numbers of people with credit products that then sell insurance products in addition.
Thanks. And 40 million is a big number, but what do you think the addressable market is?
It's absolutely vast. So just to give you, a sense from India, in India, roughly, 3 or 4% of the population has health insurance. So, there's another, one country alone, there's another, 96, 97% of India to go. So it's absolutely vast. And over the last 3 years in India, in health insurance alone, it's been growing at 30% compound annual growth. So that gives you some sense of the possibility.
Thank you. Now, I'm going to ask some questions, and as in the last session, we're going to be able to take some questions via Twitter. I've got the Twitter screen here. I think it'll be up there in a little while. Hashtag Climate Finance Day. Send in your questions, and we'll try to address as many of them as we can as we go through the remainder of this session. So if there's one theme that's come out very loudly so far, it's been the protection gap. And we've heard about it in terms of people with very basic needs in terms of insurance, and we've heard about it in terms of governments facing the potential for catastrophic, well, not just the potential, but experiencing catastrophic events. Rachel, let me start with you. Public finances are extremely stretched these days. So when it comes to, let's take a country like the Philippines, as the bank works with its clients, how do you make the case that this is something that needs to be a priority?
Thanks. Well, I think it's a good point, because what we found is so the origins of catastrophe risk were in the Caribbean. That was the first catastrophe risk facility, and then that's replicated into the Pacific now. And there are other countries that have got fairly sophisticated sort of multi-tiered approaches to this. And of course, ARC is growing very quickly. And what you see is an education of government that, first of all, that they should take some of their precious budget and pay the premium, as was already discussed. But also that what happens is that as you start working with governments in such a model, they start understanding more what insurance can do for them. And they then understand how perhaps regulatory change to the financial sector and the insurance sector may get them greater financial resilience through the economy, for business, for communities, for local government. One of the things that we see post-disasters is this mismatch of who's responsible for what and who's accountable for what between central government and local government. It's different in every country. The disaster response mechanisms are different. So you have to sort of, what we see is this general education. If I look at the Pacific, we introduced the Pacific Catastrophe Risk Facility a couple of years ago. Great reluctance amongst Pacific Island nations. They didn't understand exactly what this was all about. They have very small budgets, and we're asking them to pay premiums. What was interesting is that a donor came in and said, okay, we'll subsidize the premium just until you get used to it. So the first payout was Tonga, and we paid out within 2 weeks. That was a very important signal effect across the Pacific. And then more recently, when Typhoon Pan came through Vanuatu, again, we paid out $1.9 million within 10 days. So this sends a very signal effect, is that, oh, this might be a good deal for me. But then your weather indexing is quite important. What was interesting is when the Solomons had really bad rains, I think last year, it wasn't actually an extreme weather event. It had a profound impact, but it was a low, and the mechanism didn't pay out. So that had a signal effect as well. People were like, well, wait a minute. So I think there's first of all, refining models, educating is really important. I want to make one other point based on what Leapfrog was saying. The financial services industry has a hugely vested interest in understanding what is going on, because the mistake that the current business model for a lot of financial services companies are based on it presumes that poor people are not very sophisticated managers of their finances. You have to understand that poor people are as sophisticated, if not more sophisticated, than all of us in this room, because it's very, very, very hard to live on $2 a day. You have to make numerous, extraordinarily sophisticated financial decisions, because you don't get $2 every day. Right? You get $2, then you might get nothing for weeks, and then you may get $10. And the sophistication of the decision making is extraordinary. And so the products might be cheaper, and they may have to be distributed differently, but they don't have to actually be dumbed down. And that is the biggest growth market, and that market will be absolutely essential to our ability to be resilient to climate change.
Very well said. Yeah, Peter?
Am I on? You know, I think there's also a different but equally important protection gap. In the earlier panel, Priya Mather talked a bit about how CalPERS is looking at investment risk. And it's part of the fiduciary obligation. And I don't think that that's being really adequately communicated. I think it's being done better here in Europe than it is in the United States. I mean, we've heard both AXA and Swiss Re talk about how they are communicating, risks that they see as real and material to their clients, including sovereigns and companies, municipalities. And I think that more of that's necessary in the United States to take a bit of a U.S.-centric view, and we do have plenty of global investors who and companies who are active in our network, and some of you are here today. But boiling it down, successful insurers really know how to price risk, and we've heard that pricing climate-related risk is increasingly important to their underwriting business. The second given here that I think is important is that many investors, particularly institutional investors, still take a discursive or even an anecdotal approach to climate-related risks that doesn't link materiality to some kind of metric. We heard in the earlier panel, I believe it was Philippe from Morova, say that institutional investors historically perceive risk as volatility. Generalizations are dangerous, but I think it's fair to say that many institutional investors believe that at any given moment the capital markets provide the best reliable real-time price discovery. I mean, it's where buyers and sellers meet. So I leave you with a question. What if the capital markets are missing something? Missing something that insurers are able to see and quantify using a better or at least a different lens.
Philippe and Andres, I mean, your companies are both in the insurance business, but you also manage very substantial assets. So how do you think about the question that Peter's just raised?
I think one of the important functions of insurance is it's providing information about risk. So when you pay a premium, it has to be different if you have a house or an asset that's exposed to risk as opposed to an asset that's not exposed to risk. So I think this risk signal that you get by your insurance premium quote is very important, and I think that's probably as important as is the reducing volatility function that we have or providing liquidity function. It's giving information about risk that people can use to make smart decisions. I'm not sure that was your question, but
it's a good answer, and it partly does. So perfect. Fatima, you want to jump in, and then or Philippe, go ahead, and then Fatima.
Just a word. I mean, yes, we have also, I mean, as insurers, large investors in the market. Our first duty, of course, is to secure these investments in order to pay the claims to the customers. So that's not to be forgotten. Now, also, we are very keen to move on helping in investment, green investment, and this area move on. There may be some limit with the regulation. We need to be helped also to have the capacity to invest more on that field. I think it would be very pleased, Rachel. But this must be also dealt as a whole and seen with the regulator, with the state, and say, well, help us to help you.
Fatima.
I would make 2 points on this, and I think it's been effective for us to have the expertise of the insurance industry in pricing our risk. But pricing the risk is not sufficient for offering a product, and a contextually appropriate product. The CRIF came out of the needs of Caribbean governments post-Hurricane Ivan to fill a liquidity gap that Jim mentioned between aid and essentially where you have budget dislocation, where you need immediate public services functioning. The ARC came about, again, because of the way the humanitarian assistance lags directly after a weather shock. So I think that's the first point. The second thing is, how would Swiss Re or AXA Re price the risk of insuring a sovereign like Niger, right? The data just isn't sufficient to make educated assumptions, I guess. And I think there's then what Niger would have, or probably more so than somewhere like Senegal that's a little bit more developed, where would have essentially a premium put into the price. So what we're working on, it's a project I'm managing, is essentially coming up with a sovereign disaster risk finance rating, where we would measure 3 things. One is a country's, for Africa, a country's reserves against their quantifiable risk. Second, the operational capacity to actually deploy the funds, because an insurance payout is useless if you don't have the programmatic capacity to assist your populations. And third, the willingness and the ability to pay premium by the government, which we've seen and been surprised by. But 80% to 90% of our premium income is coming from internally generated revenues and not donor subsidies, which is exciting, I think.
We've begun to get some good questions from all of you. Thank you very much. There's one from Ian Cochran that's along the lines of this theme, which is, how do you raise awareness about these future risks in some of the more precarious or emerging economies without scaring away other investments? Is there, does the law of unintended consequences play in here? I'd like to take this. Rachel.
I mean, not a complete answer to the question, but there's a very, very important role for data. And I think what is important is the effort that's going in now to extending hydrometeorological services and data to all countries. So I mean, a lot of these countries have been working completely in the dark, and building those services out is very important. The French have made a commitment of $100 million recently to try to make sure that kind of early warning based on good hydromet services is available. The Russians, the Saudi Arabians, the Japanese, the Brits, the Americans, the Germans are all, trying to put substantial resources into this. And I think the view is that, if you can have good hydromet data, then you will be able to see product develop, etc. So partial answers the question, but an important sliver of it. And of course, I think the World Meteorological Organization is having its annual shindig in either next week or in the next few days. So lots for them to do too.
Do they actually call it a shindig, by the way, the World Meteorological Organization?
No, I think that's just the development banks that have shindigs.
Okay. Does anybody else want to pick up this question? Yeah, Peter?
Real short. I really think that what you know is less scary than what you don't know.
Zen-like words. We could almost end on that. So climate is a topic that is changing our world, and it's a buzzword. Another one is big data. So for Philippe and Andreas, we started talking about data. Tell us a little bit about what we're able to know, see, and understand now compared to, say, 10 years ago, and where do you think the big data revolution will go in helping us manage climate impacts?
So if I compare what we know today about natural catastrophe risk with what we knew 10 or 20 years ago, it's a huge difference. We know if you take a given building, and it could be almost anywhere on the world, today we would know what its risk, not only for earthquake and wind, but also flood and other perils is, at a very granular level, really per individual building. That's possible today. So in that sense, there's been a huge development. And I think we still lack a lot of data about the building itself. So how is it constructed? How is it used? Where are the really vulnerable parts? So is there a server room in the basement which is likely to be flooded? This kind of information we do not yet have. And I also believe there's, and that's where big data, where the Internet of Things will help us in the future to understand risk even better. And I think that there is also knowledge we are lacking about new risks. In agriculture, for example, how people are cultivating the land, or which crops they're using, things like that. That would be important to address new and emerging risks, which I think are equally important as the buildings.
Philippe?
I fully agree with, of course, what you said. I think that the big difference is that we are stepping in a world where we try to have a much more granularity in the risk. That means, at least for the territories, if you take today, parametric insurance for crop insurance, we are just through satellite looking at squares which are 250 meters size. And in the coming years, that will not be 250 meters, but a few meters. So we are progressing a lot. When we were we had at the time, maybe 10 years ago, we had a very rough view on that, which at the same time helps to assess exactly what happens and what risk we have, but also help. We have to have the capacity to tell one person, well, you acquired this house maybe 3 years ago, but you don't know the history. We can tell you the history of this house. And this has been flooded in the last 20 years 3 times, and with this haste of water, and what was the damage. And through the big data, we can access to that. Well, it takes time, as you mentioned, because big data is, well, big. That means you have to organize those data, which is not so easy. But that's the trend. The trend is more granularity, knowledge about what's happening on a very, very thin way to assess that. Is it sufficient? Maybe not, because you have still the climate change. So the change is going. So we cannot say we take a picture today and say, well, now we are happy, we are capturing that. We've got to try to anticipate what could happen, which is not easy. Actuaries would tell you, climate change, yes, but we don't know yet, because we need a series of statistics for the coming years to know exactly what will happen, except that if we just wait 20 years, it will be too late. So we've got to work also, and that's what we do, try to anticipate and work out scenarios, which is not easy, because very often we are taken by surprise. But okay, that's the game.
Jim, before coming to you, question back here for AXA Swiss Re. As you get more granular with that information, does that create spikier pricing? So, and what do you think the implications of that might be?
It's very evident that it brings to more granular pricing too. Yes, definitely. Price each risk for its own merit, if I may say so. Yes. To some extent, because they are a level where the granularity doesn't help anymore. But yes, that's true.
And I guess where I'm going with it, on the one hand, it could create incentives for people not to put themselves in harm's way vis-a-vis climate. On the other hand, it might widen the protection gap as people simply decide that higher premiums are not worth paying. Is that? What do you think of that scenario?
The gap is clearly an issue, and you mentioned, that you can solve at least partially the issue by doing lean management and very low cost, which is one of the answer, and it works. You've proven that it works. On top of that, there is, when I mentioned once again prevention, because that's very critical. Before saying, well, I price you that, could you help by doing this and this action, which really mitigate your risk? And this also has to be done in close coordination with the public domain, because that cannot be managed only by the industry. We do work a lot with the World Bank, we work with United Nations and so on, and also with the public domain, the large public domain, and there's a big progress to make to coordinate all that.
I'm going to come back to that in a minute because we have a question on that from Twitter, but Jim's been very patient.
It's really on big data, and full disclosure, I'm a nerd and I love big data, and I love parametric insurance and spend lots of my own spare time looking at these things. And I think one of the things that I'd like to caution about is that they are very kind of exciting and sexy solutions. But my sense of where I think we're going to get a lot of traction is really through very simple bread and butter sorts of things. So, finding out which models for selling insurance, the kinds of insurance that people want to buy, home insurance and car insurance and health insurance are working in Africa and Asia, and then really just rolling those out, investing in those businesses and allowing them to hire more people and simply rolling them out. There's a ton of scope there for really accessing billions of people, and I would just kind of caution about throwing the spotlight too much on the exciting and the sexy and away from the more mundane but effective.
Not a silver bullet. Yeah, Fatima?
I would argue you need both, and I think it's because to achieve the scale and to be able to crowd in the meso level and micro level products, you really do need a hedge at the national and at the regional levels, which a regional risk pool like the CRIF or the ARC or Pacific Pool in the future could provide. But I mean, I would say that I just wanted to say the ARC has also taken and World Bank Treasury as well, taken steps to allow the private sector to be able to speak with the public sector and with the most vulnerable populations. And ultimately, that shouldn't be needed in the future. But what we are developing, and two very specific public goods on data that we can share, is our drought model, the flood model, which will be the first parametric flood insurance model in the world, aside from very specific high-value markets in the United States. And we're working with that. The resolution is currently 90 by 90 meters squared, so we're significant improvement over the 250. And the first results are showing pretty robust results for the Namibia-Angola area where we've tried it. But that opens up a lot of opportunities for licensing for development, as we call it, where ARC offers specific products for sovereigns, but those who are interested, like other insurance companies in the micro or meso level insurance, could use these models to be able to insure commercial agriculture, essentially, in Africa. So it's the first thing. And then the second thing is, I think, for the XCF, it's the Extreme Climate Facility offers a way for the private markets to essentially price the uncertainty and the probability of climate change actually happening, right? And it's a data-driven approach that allows us to not say, well, we're going to need $15 billion of investment every year for the next until 2050, but a way to channel the money that as needed goes into climate adaptation.
Great. Let me come back to one question on data, which we've sort of gotten close to but haven't come straight at. A question from Twitter that says, well, shouldn't these data be basically mutualized? Shouldn't this be a public good? What, any reactions to that idea? Rachel?
Well, I think that you are seeing, I think it's a fast innovating field, but you are seeing some innovation where this is actually the data, apart from the modeling and the parametric and the hydromet and all the rest of it, which has to come with a certain degree of science behind it, you're seeing bottom-up sort of crowdsourced data as well. So we've worked with Google Maps, Google Earth, and with experiments in the 9th district in New Orleans, where where the most vulnerable and the most isolated members of the community, crowdsourced basically the data around different properties, around property lines, around houses, etc. And also in the process of so doing, formed a community opinion around where they wanted to build their own resilience. That was something that we were then able to replicate in, in Nepal. And that data is still there and will provide roadmaps in the recovery process. I think you're also seeing some very important open data initiatives around, for example, the resilience and the first attempt to build resilience into public buildings, into hospitals and schools, especially for those communities that are vulnerable not only to hydrometeorological disaster but also to geophysical disaster. So, if the schools are at code, and the schools are understood, they become community resources. So you are seeing open data, and you are seeing bottom-up crowding in information, as well as then some of the more sophisticated or differently sophisticated scientific efforts as well. So just 2 examples.
Peter, and then I'm curious to get the reaction from Andreas and Philippe on this.
In my opening remarks, I talked about data like this and analysis becoming more a part of the public domain and how it could benefit investors, municipalities, companies. I do think that that's selectively going to be happening going forward. I think I'll pass it over to you right now, but I think this is an important direction we're going to, and it's going to help sort of create that common language that I keep talking about.
Open data are already existing. I mean, you can access to a lot of data on the open source. It's available for everybody. And you can access to some weather evolution data also. Everybody can access to that today. It was not the case previously, but now it's. So there's a big part of the data which is already very open. Then also the industry is organizing itself in some cases where we exchange or we create some common tool in order to then provide solutions like perils that you, 3 knows very well, and us, because we have created with our peers such a way that we have an agency which owns all the data for wind speeds in Europe, and that's shared. So yes, it is possible to share. Maybe not all the data, but a big bunch of them, yes, and even not only what is just directly available through the internet, but also organized by the industry.
Actually, I believe that sharing data is crucial to understand risks. So in that sense, I'm fully for sharing as much data and using as much data as possible on risk so that we can assess it. But I also believe that it's a two-edged sword. So if I own data, so I'm someone owning a house, or it could be my health data, and I'm asked to share that with my insurance company, and then I suspect, well, now the price is going to go up, and you mentioned that earlier. I think that's a really big danger that we, the insurance industry, are in. So we have to make sensible use and responsible use of the data. And I don't believe that the only possibility is to basically have every risk, every individual pay the exact price that they represent in terms of risks for the insurance policy. Insurance is also about creating pools of people that have a common interest, that have similar risk, and then share the risk in that group of people, individuals, governments, cities, whatever it may be. And I think this is the art of insurance. Calculating the exact price is, I would almost say, easy, but creating risk communities that are willing and able to share risk, that's the art, and that's where we need to go. And if we are able to do that, then we should have or should be entitled to also get the data to fulfill that function.
Jim.
Yeah, so, I mean, there's some data that's obviously shared where it's in the mutual interest of insurance companies to share it, or the data has been produced by the state and so paid for essentially by taxpayers. But I guess I would really caution against some situation. And data costs money to generate. Somebody has to pay. Data doesn't just arrive for free. Somebody has to invest. An insurance company has to invest very heavily to generate data. And I would really caution against solutions that essentially compelled insurance companies to hand over data that they have invested very heavily in collecting. I think that could be an absolute disaster because it would create disincentives for them to invest in the collection of data.
Yeah, Peter? Not sure.
Hello? We've gotten used to talking about tipping points, and I think a useful tipping point to discuss is like a tipping point of awareness or consciousness, and how important is it for the companies and municipalities, the investors, to have their aha moment, as it were, that they say, this is interesting. This data and analysis done by insurance companies, it's telling me that they're looking at this situation very differently than I am.
Thank you. There's another question from Madeline Meyer on the Twitter feed, and I don't know, I'll just throw it out there, see if anyone has an answer. The discussion here today, it's an amazing turnout. I think there are 1,100 people registered. We had 1,700 people here for the prior 2 days' events. Absolutely wonderful. Does this represent the mainstream of the investment community, is the question. How much have things changed? Or are we talking, is this the convinced talking to the already convinced?
You're a captive audience. I'm going to put in a brief advertisement because I actually think it does. And my advertisement is that next January, Ceres is going to again be convening 600 to 700 investors at the UN, as we've been doing every 2 years, to keep all these issues alive. And we hope that you'll all attend. But the investors who attend the UN meetings that we sponsor, they are by and large the mainstream investors, and the approach they bring is policy is important, but we're not going to wait for the policymakers to affect change.
Peter, let me, not that I disagree with you, but let me play devil's advocate, not on your plug, but on the argument. Are those people who are operating within pockets of large institutions, or do they reflect broad change within those institutions?
Aaron, the only fair answer is both. I think what's happening is that the pockets are generating change. The advocates within those pockets are having their voices heard throughout the organization, and it's filtering up. In a few cases, as we've seen here and a couple of other panels, the direction is down, but there's an awful lot of grassroots movement.
Jim?
Yeah, I mean, I guess I would just have some concern about the very kind of premise of the question. I mean, I've been involved in the insurance industry for a long time now.
Blame Twitter for the question, by the way.
Okay, I won't blame you. So the insurance industry has long been concerned about climate change, in my experience. Climate change introduces all kinds of risks into the modeling of insurance companies and how they price products. And insurance companies are also people and part of communities and concerned as individuals about climate change. So I don't see a significant shift. What I do think is a very positive, significant shift is that there is, I guess, post the various different major climate change conferences, less of an adversarial stance between the NGO community and the business community. And that's the real change that I see, and that's the really positive change. But the short answer is no, I don't see a very significant change in the attitudes of the insurance industry towards climate change. I think these have been long-held views.
Rachel?
I'm not in a position to judge the health of the insurance industry per se, but I mean, I think these events this week have been different than previous events, but Is that representative of the whole worldwide business community, financial community? No, I mean, there's a direction of travel and we're on the journey. But there are two big questions we haven't talked about in this panel that I think have been posed to the insurance industry in a number of conversations in the last few weeks and months about the seriousness with which it really has internalized climate. One is the investment and asset management aspect of the insurance business. Now, a number of big insurance companies are moving in directions, and there's been big pledges made at the UN in October. But, you know, if that's real, then all insurance companies should be looking at that, and that shift from, you know, where the risk is associated on their asset management side has got to be sort of mainstreamed through. The second one is, if the insurance industry understands climate risk at the level of nuance and sophistication that it says that it does, why does it have such a sort of blunt set of instruments with which to provide products to its services? So the question at the World Economic Forum in January, which didn't get an answer, was, well, you know, if you understand the direction of travel, if you understand the volatility and the uncertainty, why are you only offering one-year insurance products? Where's the multi-year product, and where is the multi-year support to your clients? So I think that within the insurance industry, this is an industry that understands the risk much better than some. The full consequences of that for the insurance industry itself, I don't think have yet bled all the way through. And that's going to be very interesting to watch.
As in a lot of industry, other industries as well. Andreas, Philippe, any reactions to those thoughts?
That's a very interesting point. When you speak about multi-year, for example, insurance, we say, why not? I mean, there are some, whatever. It does exist. It's really a question of adaptation to the needs. So I would not say, I mean, that maybe, and to be at the risk to be a little, I mean, naive, I mean, yes, insurance on a very traditional way has been to some extent rather rigid. Now, whatever we want and whatever we need to be much more adaptable to what are the real needs, either the municipalities or the individuals or the enterprises. So I would say if we don't adapt, whatever, we will disappear. So I don't see such a barrier today, or if there is still a cultural barrier, I don't see in my group. We've got to adapt, and we have started this journey. Now, of course, when we speak about a journey, it takes time. There are different steps. And I think that's the very interesting thing is that emerging markets for us will give us lessons even for the mature market, because we've got to speed up and do better, as you mentioned, because we've got to adapt to the real needs and how people react, and not what we want to impose with our models. I fully agree on that. So I think that we have started the journey. I don't say it's perfect by far, but we have started the journey.
Andreas, sir?
If you look at the balance sheet of an insurance company, or at least Swiss Re, most of the investments are fixed income bond investments, government bonds, and we have to invest in these instruments because we need to match the currencies and also the duration to the claims we expect to pay out. So in a way, our freedom to invest in a climate risk efficient way is very limited by the purpose of the investments, but also by regulation. But what I believe would be a good development, if that existed in the capital markets, would be if we could invest in infrastructure. So if roads and dams and other investments that governments have to pay for from tax money, if this could be investments for companies like insurance companies, banks and other investors, and if you had this kind of investment, obviously it would be very important to assess the risk that comes with it and maybe even assess the risk that it mitigates. So in that sense, if there would be a new asset class, that could help solve the problem.
Jim, last comment.
It's just really a caution on the asset management side. So something that, you know, a comment I often hear is, well, you know, insurers collectively control, I don't know what it is, but I wouldn't be surprised if it was, half of the planet's savings collectively. If they invested those assets in carbon neutral technology and carbon neutral assets, this could have a very transformative, effect. And I guess it's just a word of caution, echoing my colleagues from Swiss Re and AXA, that firstly, insurance assets, you have to match assets and liabilities. You have to have, you have to be able to pay claims from the investments that you make, and also regulators compel insurance to regulate, to invest in particular asset classes. And so there's a long road ahead, and it's not quite the simple solution that it's often made out to be.
Well, there we are. Last comment, and the headline is, "It's not as simple as it's made out to be." I think the direction of travel is clear, or the end goal is clear. The way we get there, this is what we're all here to understand and to strengthen and to improve. So I'm going to introduce our next speaker in just a moment, but before I do, please join me in thanking this great panel for sharing their thoughts with us today.